Now let's look at the key aspects of a project financing model. So this financing model will help. How do you value a project? What, based on your various assumptions, what do you think is the rate of return which the project might generate? So there are two phases involved in it. One, create the end-to-end model based on the assumptions. Probably go ahead up to the creation of the financial statements for the project, projected future financial statements for the project, including the profit and loss statement, the balance sheet, and the cash flow statement. Use that information to arrive at the rate of return which the project might generate. That is the phase 1 of this assignment. And in the phase 2, we would be even more interested in doing a what if analysis, which is nothing but the sensitivity and the scenario analysis. By changing a few of our assumptions, we would be observing what kind of input it has on the outputs, which are more like your rate of returns or the futuristic cash flows, in what years the negative cash flows and positive cash flows might come out. All these things can very well be analyzed, especially when we are doing a end-to-end project financing model. Typically, again, just to give a basic theoretical aspect of any project financing model, most of the projects today have a SPV created. The sponsor is creating the SPV or SPE, special purpose entity or a special purpose vehicle, that will be taking care of going ahead with the project. So they get into various agreements with various parties. It's not the sponsor company that gets into an agreement. It's that special purpose vehicle, which means that company is created exclusively for the purpose of executing that project. Because these projects typically have a very long-term life, a 30-year or a 40-year kind of projects. This company is created exclusively to handle that project, and once that project is over, this company also gets closed down. So those kind of companies are called as special purpose vehicles or special purpose entities. This particular company will get into a concession agreement with the concession guarantor. Could be government or any other entity which is offering the project. So there will be some kind of concession agreement with that party. The same SPV approaches the lenders and gets into a facilities agreement with them, and it gets into agreement with the contractors to do the construction part, engineering, procurement and constructions contract. It could get in tie up with the operators to get into an operations contract, because typically the project might involve a simple project might be a kind of a BOT kind of a project where there is a build, operate and transfer. So for building the entire project, the SPV may get in tie up with an EPC contractor. For doing an operations of the project, probably with some kind of an operator, the tie-up could very well happen. And even the people who are funding the project, either in the form of lending or as equity, there would be shareholders agreement and memorandum of association associated with. So typically the SPV will get into the responsibility of getting into all these kind of agreements with various entities to kickstart this particular long-term project. So just getting into the simple details of it. In the concession agreement, generally it is between the grantor, who could, most of the cases will be a government authority, and the SPV. So the government typically gives the rights. Now in this agreement, what happens? The government transfers the rights to build, own, operate the project for a specific period of time. So SPV will now have the right to build that particular. So if I am talking about a metro rail project in a particular city, so the government, there is government